VIP John AG here. I need to be honest with you about something, and this is not easy for me to say. I have been stacking silver for years. I have been making videos about silver for years. I have told you over and over again that the fundamentals are undeniable, that the squeeze is coming, that patience will be rewarded, and I still believe that. But something has shifted in the data recently that forced me to sit down, re-examine everything, and change my entire strategy. Not abandon silver, not sell my stack, but fundamentally restructure how I approach this market going forward. Silver is sitting right around $33.50 on the COMEX as I record this. Gold just pushed past $3,300 an ounce and is flirting with all-time highs again. And here is the part that made me pause. The gold to silver ratio is hovering near 99 to 1. Let me say that again. It takes nearly 100 ounces of silver to buy a single ounce of gold. Historically, that ratio averages somewhere between 47 and 65 to 1. In the ground, the geological ratio is roughly 8 to 1. At 99 to 1, silver is either the most undervalued asset on the planet, or the market is telling us something we do not want to hear. I had to sit with that question honestly, and the answer I came to changed everything about how I am positioning myself. So stay with me, because this is going to be one of the most transparent videos I have ever made. Let me give you the full picture with hard data so you understand why I had to rethink my approach. Gold has been on an absolute tear. Central banks bought over 1,136 metric tons of gold in 2024, and the pace has not slowed down. China's People's Bank of China has been adding to reserves for months on end. Poland, India, Turkey, Singapore, they are all accumulating at a pace we have not seen in decades. The World Gold Council confirmed that central bank gold demand has remained above 1,000 tons for 3 consecutive years. That is not speculation. That is documented, verified data. And what is the result? Gold breaking past $3,300. Multiple analysts now projecting $3,500 to $4,000 within the next 12 months. Goldman Sachs recently raised their year-end target. UBS has gold going higher. Even the mainstream outlets that ignored gold for years are now forced to cover it. Now let us look at silver. Silver has industrial demand that gold does not. Solar panel installations consumed over 232 million ounces of silver last year, a record. Electric vehicle production requires silver. Every AI data center being built needs silver for conductors and connectors. Defense applications, medical devices, 5G infrastructure, all of it requires physical silver. The Silver Institute reported a structural deficit for the 4th consecutive year, with total demand exceeding supply by roughly 182 million ounces. 4 consecutive years of deficit. And yet, silver is sitting at $33 while gold is at $3,300. The ratio is screaming at us. But here is what I had to be honest with myself about. The ratio has been elevated for years. I have been talking about mean reversion for years, and it has not happened yet. So I had to ask myself a hard question. What if the ratio stays elevated longer than I can stay patient? What if the market structure is fundamentally different now than it was in 1980 or 2011? That question forced me to adjust. Let me walk you through the COMEX data because this is where it gets really interesting. COMEX registered silver inventory has dropped significantly over the past 3 years. We went from roughly 150 million ounces of registered silver down to numbers that are a fraction of that. Eligible inventory has also been draining. Total COMEX silver vaults are holding significantly less metal than they were just 2 years ago. Meanwhile, delivery notices have been elevated. We saw months where deliveries spiked in ways that raised eyebrows. Large traders standing for delivery rather than rolling contracts. That is a physical demand signal that the paper market cannot hide forever. But here is the flip side, and I have to give you both sides. Open interest has also been volatile. We have seen periods where speculative long positions get flushed out through coordinated margin hikes and short-term price smashes. The banks still have enormous short positions on the COMEX. The bank participation report continues to show that a handful of institutions control a disproportionate share of the short side. This has been the case for years, And while it frustrates every single one of us, it is reality. They can push the price down in the paper market faster than physical demand can push it up. That is the game. I have said it before and I will say it again. The paper market and the physical market are two different worlds operating under the same ticker symbol. Now let me talk about Shanghai because this is critical. The Shanghai Futures Exchange has been trading silver at a premium to the COMEX. We have seen premiums of 2, 3, sometimes 4% or more over the London and New York benchmarks. Gold premiums in Shanghai have also been elevated. What does that tell you? It tells you that in the East, where they actually take delivery and use the metal, the price is higher than in the West, where paper contracts dominate. This is not a new phenomenon, but the persistence of the premium is telling. It means physical demand in Asia is outstripping what the Western paper markets say the price should be. China imported massive quantities of silver last year. Indian silver imports hit record levels. These are nations that understand the difference between holding paper and holding metal, and their buying behavior tells you everything you need to know about where they see value. Now, looking at the numbers, about 75% of you watching right now are not subscribed. If this kind of unfiltered, data-driven analysis is cutting through the noise and giving you clarity, hit that subscribe button. That is how we grow a community built on truth, not hype. Drop VIP John AG in the comments so I know who the real ones are. I do not sell signals. I do not sell mentorships or courses. I do not push affiliate links for dealers. This channel exists for one reason, to give you the raw analysis that mainstream financial media will never provide. If that resonates with you, subscribe. If it is not for you, no hard feelings. I do not chase empty metrics. Here is what makes this truly insane, and this is the part that changed my strategy. I have been predominantly a silver-focused stacker and analyst. My conviction on silver has not wavered. But when I sat down and looked at the math, really looked at it, I realized I was making an emotional decision by ignoring what gold was doing relative to silver in the near term. Let me explain. Gold is being adopted by central banks at a record pace. Gold is the asset that sovereign nations are choosing to de-dollarize with. Gold is what the BRICS nations are accumulating as they build alternative payment systems and potentially a new trade settlement currency. The geopolitical landscape has shifted dramatically. We have active conflicts in multiple regions. Sanctions regimes are pushing nations away from dollar-denominated assets. Russia has been cut off from SWIFT. Iran faces ongoing sanctions. China is preparing for potential economic decoupling scenarios. In every single one of these cases, the asset they are turning to is gold, not silver, not Bitcoin, gold. And the price is reflecting that. Gold has outperformed silver significantly over the past 2 years. If you held gold, you are up dramatically. If you held silver, you are up, but not nearly as much. And here is the smoking gun that forced me to rethink everything. The institutions, the biggest, smartest money on the planet, they are accumulating gold aggressively right now. JP Morgan, the same bank that has been accused of manipulating silver for decades, reportedly holds one of the largest physical gold positions in history. They are not doing that by accident. They have analysts and algorithms and insider knowledge of monetary policy direction that we do not have. And they are choosing gold. When I see central banks buying gold, when I see JP Morgan accumulating gold, when I see the BRICS nations hoarding gold, and when I see gold outperforming silver by a wide margin, I have to be intellectually honest. The near-term momentum is with gold. And here is my adjustment. I am not selling a single ounce of silver. Not one. But my new acquisitions are being weighted more heavily toward gold than they have been at any point in the last 5 years. I am shifting from an 80-20 silver to gold ratio in my purchasing to something closer to 50-50. Because if the gold to silver ratio stays elevated or even expands further, I want exposure to the asset that is running right now. And when the ratio does eventually contract, and I believe it will, I can always convert gold into silver at a more favorable rate. That is the strategy shift. It is not about abandoning silver. It is about being tactical and letting the data, not my emotions, guide my decisions. Now let us talk about physical versus paper, because this contrast has never been more important. Walk into your local coin shop right now and try to buy Silver Eagles. You are going to pay $5, $6, $7 over spot, maybe more. Premiums on 1-ounce silver coins have remained stubbornly high even when spot price dips. Why? Because physical demand has not let up. The U.S. Mint has had production constraints. The Perth Mint has reported elevated demand. The Royal Canadian Mint continues to see strong sales. Dealers across the country are telling me that walk-in traffic is increasing, not decreasing. People are buying. First-time buyers are coming in and asking for silver and gold. That is a ground-level demand signal that no COMEX report can capture fully. Meanwhile, on the paper side, we see massive volumes of contracts traded every single day that have no connection to physical metal. The notional value of silver derivatives dwarfs the actual available supply of physical silver by orders of magnitude. This is the disconnect. The paper market sets the price, but the physical market reflects reality. And right now, reality says silver is scarce, in demand, and being consumed by industry at a pace that mining supply cannot match. The physical market is telling you one thing. The paper market is telling you another. I know which one I trust. Let me address the bearish case head-on because balance matters, and I refuse to be one of those channels that only tells you what you want to hear. The bears have legitimate points. First, if we get a broader market liquidation event, silver gets hit hard. It happened before, and it can happen again. Silver is a thin market with leveraged participants, and when margin calls come, silver gets sold first. Second, the Federal Reserve has not committed to aggressive rate cuts. Rates remain elevated. The dollar, while under long-term pressure, is still the world's reserve currency and has shown resilience. A strong dollar environment is historically tough for metals in the short term. Third, margin hikes on the COMEX can come at any time. We have seen this playbook before. Price starts running, retail gets excited, and then the exchange raises margin requirements, forcing small speculators to liquidate. It is a tool of control, and it works. Fourth, there is a scenario where industrial demand slows if we enter a global recession. If manufacturing contracts, if solar installations slow down, if EV adoption plateaus, silver's industrial demand thesis gets challenged. I do not think that is the base case, but I have to acknowledge it as a possibility. These are real risks, and if you are not accounting for them in your strategy, you are not investing. You are gambling. Now here is the bullish case, and this is where my long-term conviction remains rock solid. The supply deficit is structural. It is not going away. Silver mining supply has been flat to declining for years. There have been very few major new silver discoveries. Permitting a new mine takes 7 to 10 years on average. Even if silver hit $50 tomorrow, we would not see meaningful new supply for nearly a decade. Meanwhile, demand is accelerating from every direction. Solar is the fastest growing energy source on the planet, and every panel requires silver. The global push toward electrification requires silver. Artificial intelligence infrastructure requires silver. Military and defense applications require silver. And on top of industrial demand, you have investment demand that is growing. Silver ETFs have seen inflows. Physical buying is strong. Nations in the East are importing record amounts. Central banks may not be buying silver the way they buy gold, but the private sector is absorbing physical silver at a pace that is draining inventories. COMEX, LBMA, Shanghai, everywhere you look, above-ground stockpiles are declining. The math does not lie. When you have 4 consecutive years of deficit and declining inventories, the question is not if the price will adjust, but when. And when it does, the move could be violent because silver is a tiny market. The entire annual silver mine supply is worth roughly $26 to $28 billion. That is nothing. Apple has more cash on its balance sheet. A single large fund deciding to allocate 1% to physical silver could move the entire market. As I said in a previous video, the spring is being compressed, and the tighter they push it down, the more explosive the snapback will be. Nothing in the fundamental data has changed my long-term thesis. Silver above $50 is not a question of if, it is a question of when. And I believe gold above $5,000 is equally inevitable given the monetary debasement trajectory we are on globally. But in the near term, I have to be smart about how I allocate, and that is why I adjusted my strategy. 3 key takeaways, and we are out. 1. My long-term thesis on silver has not changed. The structural deficit is real. The industrial demand is accelerating. The supply constraints are severe. Silver remains the most undervalued monetary and industrial metal on the planet. But the near-term momentum is clearly with gold, and ignoring that is an emotional decision, not a strategic one. I am adjusting my buying ratio to reflect that reality while maintaining my core silver position completely intact. 2. The gold-to-silver ratio near 99:1 is historic. It either represents the greatest buying opportunity for silver in a generation, or it reflects a market that has structurally changed how it values these two metals. I believe it is the former, but I am hedging by increasing my gold allocation now and positioning to convert back to silver when the ratio contracts. 3. Physical metal is the only truth in this market. Paper prices can be manipulated, contracts can be settled in cash, and derivatives can create infinite synthetic supply. But a 1-ounce silver coin in your hand or a gold bar in your safe is real. It has no counterparty risk. It cannot be debased by a central bank, and it has been money for over 5,000 years. Keep stacking physical, but be strategic about what you stack and when. The unresolved tension is this. We are watching central banks around the world prepare for something. They are buying gold at a pace not seen in over 50 years. They are building alternative payment systems. They are reducing dollar exposure. They are preparing for a monetary reset that most people do not even know is coming. The question is whether silver gets pulled along with gold when that reset accelerates, or whether silver's moment comes later, after gold has already repriced. I do not have the definitive answer to that, and anyone who tells you they do is lying. But I can tell you this. Being positioned in both metals with real physical holdings, not paper promises, puts you ahead of 99% of the population that holds nothing but digits in a bank account backed by a currency losing purchasing power every single day. Do your own due diligence. Understand the risks. Be accountable for your own decisions. This is not financial advice. This is one analyst sharing publicly what he is doing with his own capital and why. Invest with logic, not hype. VIP out.